Hello, we're back with Ben Johnson from Morningstar, and we're going to talk about multi-factor investing. So Ben, let's just start with the definition. What is multi-factor investing?
So I think before you can understand what multi-factor investing is, you have to understand what factors are. And what factors are these interesting little creatures that are out there. So in the beginning, there was the capital asset pricing model that told us that there was the return on the market, and that was incremental to some sort of risk-free rate of return. But academics subsequently went and they've decomposed the return on stocks and on bonds into a variety of other factors. So it's a bit like sort of particle science or even nutrition science, in that first we saw atoms and then we realized there were protons, neutrons, and electrons. Or you see food, but food is really just some composition of fat, protein, and carbohydrates. So such are factors. So what are these factors? Factors are things like value. Turns out that it makes sense to buy stocks for less than they're worth and have them run up to some approximation of their intrinsic value. Things like momentum, this sort of behavioral phenomenon that exists because people underestimate either sort of earnings surprises or a continuation in a trend of growth for a particular firm, and stocks have a tendency to run too far either in the upward direction or the downward direction, such as momentum. There are other things out there like the size premium, which some argue exists, some argue might not exist. So smaller companies in theory are a bit more risky, they're certainly more volatile, and as such you would expect above average returns from investing in a portfolio of smaller than average companies. So you have these various factors: size, value, momentum. Others might include quality, low volatility, dividends. So when you have these individual factors, what you see is that they're all sort of their own individual fickle beasts. They have different personalities, they perform well in different market environments, they might lag in different market environments relative to just the market at large. So the idea of multi-factor investing is that you're setting out to exploit what is the only free lunch in investing, which is diversification. So I'm going to isolate these various factors and then combine them, because some of them zig when others zag. And if I pair them together in a way that makes sense, what I can get is a smoother ride and potentially better risk-adjusted returns.